Okay, welcome back to my Vanguard portfolio update. This is going to be the final one now of the year. I cannot believe we're already in December. What a roller coaster ride this one's been for investors. Certainly if you started at the beginning of the year, it feels like it was like January, and then we've pretty much gone all the way down, and maybe we'll get a Santa rally, but we can touch on that one later. Anyway, just before we head into the numbers and have a look at my stocks and shares ISA and my SIPP, let's have a little bit of a deep dive on what's actually gone on in the stock market this past month and all the different crazy news events, especially over in the US. Okay, so as I mentioned in one of my other portfolio update videos over on Hargreaves Lansdown, I think some of the biggest news, of course, was that inflation data that came out over in the US. Now, finally, we saw that come down just a little bit more than expected, and that set the stock market off into a crazy frenzy rally, which at least lasted for a day. Not to say that it's all been held up there, but things went absolutely crazy out there as investors suddenly thought, right, inflation is coming all the way down again. Now, just on that topic of inflation, I think lots of people agree and they say my inflation figures, my own personal life, are way more than the government comes out, both in the US and of course here in the UK. Now, one interesting source that I've just come across quite recently is this website called Trueflation. Now, I don't know exactly what their methodology is, but it seems to track more of what you might experience in the real world. So as you can see on screen now, this is the graph for US inflation, and this darker colored line is what they think, Trueflation think, is actually the real rate of inflation. So you can see when it actually peaked earlier in the year, they think it should have been more like 12%, which I'm sure that a lot of Americans would probably agree with, especially what they were paying at the gas pumps. And then the blue line, of course, is the official data from the US government, from the Bureau of Labor Statistics. Now, what's interesting here, of course, as we kind of move further forward and Trueflation are presenting their data in real time and live, they do show that inflation is going to continue on that way down. Now, the latest data that you can see here does show that inflation should be coming down. So whatever the data that Trueflation are collecting and all of that real-term information should show that the next data we get through from the US officially of the US government reported rate should actually be coming down as well. So in touch wood, this should be a pretty good result for investors. Now, of course, that's just the US, but if I just flick to our UK dashboard here, look at this. This does not look good at all. This is the 1 year chart, and they're predicting things just to get worse and worse and worse. And of course, we would have already seen that from the Bank of England with the latest inflation data, which is what hit just over 10%. We're at 11% now, unfortunately. This suggests that actually things are going to get a bit worse. And one of the biggest contributors to that are energy prices, as they've completely soared and gone through the roof, because we're paying on the market for that spot price, haven't got any storage, and the pound has been really weak, as you know, and the dollar has been very, very strong, which all of these commodities are traded in. Anyway, back to the stock markets, and as you can see, the S&P 500 and the Nasdaq should both be up around 5%, but I bet by the time I get on my computer and edit this, something else has changed, because I think the jobs data comes out as well as I actually film this video. So who knows, but we're not near those lows and those bottoms anymore. That's not to say that anything can happen in the short term. Santa could come and give us a December rally, or we could end up even lower. Honestly, anything could happen. Now, just touching on those subjects like the jobs data and the rates of inflation. Now, we did have those meeting minutes from the FOMC over in the States, and they did seem to be talking a little bit more dovishly now about those rate rises of interest rates. And rather than 75 basis points, which they've been doing so far, we're looking now to be doing kind of the 50 basis points. And that should go up to about, who knows, maybe around the 5% mark. And we know that investors absolutely love their low interest rates. And as the big man himself said, Warren Buffett, interest rates are like gravity on the stock market, and you'll typically see this in action. So high interest rates will have a very strong force and push down on those stock market prices, whereas low interest rates will let stock market prices go back to the moon and go back to levels we've never seen before, just like over the past couple of years. Now, I'm not going to make any predictions on inflation data or how high interest rates will go. Do remember that the US Central Bank also has that remit to keep employment in check as well. And at the moment, employment's looking relatively strong, but we are seeing a slight weakening in the job market. Now, a weakening in the job market should, in theory, mean that people are going to have less to spend, people have got less power to negotiate higher wages, and without those higher wages, you should see a bit of destruction in demand from people wanting to buy goods and services in the economy, which then should have that effect of reducing those levels of inflation, because there'll be less money flowing around going after the same amount of services. That's just your basic economics 101. Less demand out there, the same amount of supply, then prices should come down. What effect that will have on the stock market is anyone's guess, and when we see those bottoms and when we see things rise, is definitely an area that I try to stay away from, trying to time the market. But it is worth reminding us that central banks also have that role as well, not just to keep inflation under control. A couple of other interesting stories this month, with Apple slightly concerned about their supply chains as more lockdowns in China happens. They are concerned that they can't get enough of those iPhone 14 Pros especially over to the UK, over to Europe and over to the other key markets in time for the holidays. And I think at the moment those iPhone Pro models are still quite in high demand, as people are preferring to go for the higher end ones rather than those lower ones, the iPhone 14 and the iPhone 14 Plus. It will be really, really interesting to see how those numbers turn out for that holiday season. So we'll keep an eye out for that one over the next quarter. Now, this one's really important because Apple makes up such a large chunk of those indexes, and certainly on the S&P 500 and the NASDAQ. I think the NASDAQ, it makes up nearly 10% if I'm not mistaken. I'll just put that on screen now, what Apple actually does. And if Apple falls, that brings everything else down with it. So it's just a reminder that Apple really is a cornerstone of those indexes once you build yourself up to be such a big company. And finally, what a weird year it's been for investors, not only in the stock market, but also in the bond market. It's not an area I pay particular attention to, or don't necessarily know all of the different inner workings about the bond market. But the fact that it's having one of its worst years along with the stock market is definitely a reminder that there's nowhere to hide, and diversification is extremely important. Anyway, with that update out of the way, let's jump into the portfolio and actually have a look how we're doing in real time. Okay, so let's get started. This is the Stocks and Shares ISA. Don't forget that this is your tax protected account that you can use in the UK, and you can contribute up to £20,000 across your different ISAs every single tax year. And moving forward, I do think it's going to be one of the most important accounts that you can use as an investor, but we can touch on that more as we go into the new year. As you can see here then, the total is £11,409.51. Every little helps. And our personal rate of return is 3.95%. Now you can see actually where I started the portfolio not that long ago, back at the end of 2021 in September, near the end of the crazy bull run. I contributed once as a lump sum and £10,000, but then also put in more money as we started 2022. And then we can pretty much see as we go along what's happened throughout the rest of the year. Now, for the keen-eyed amongst you, you might be thinking, well, this looks very, very stable. This looks nothing like the stock market. This looks nothing like the S&P 500, which you're mostly invested into. And the thing we're missing there is exchange rates. So as the pound has weakened against the dollar by 15-20% throughout the year, that has effectively meant that our investments priced in dollars have kind of kept themselves afloat, and it appeared as if they haven't done much. Now, flipping that round on its head, if the pound does strengthen against the dollar and the stock market over in the US stays the same, then we will see our investments decrease, unfortunately. So it swings and roundabouts with exchange rates. One of those things you kind of need to pay attention to. I would hope that over in the very, very long term, as a long-term investor, that as you just dollar cost average all the way along the way, sometimes you're going to get a good rate, sometimes you're going to get a bad rate. You can hedge your bets. Personally, that's not something I'm into. Could have definitely bet that a couple of months ago, there's no way the pound can get any weaker and it's only up from here. But again, we could be at a new normal where the pound stays that way for a very long term. But again, something that I don't really want to worry myself. I'd rather be focused as a long-term investor, just trying to get as much in the account as possible. And then over the long term, hopefully things will smooth out. Now, going to the actual holdings in the account, you can see it's made up from two different ETFs. Very, very simple, nice and easy ones. That is the S&P 500 ETF, which is VUSA, a very popular one here on YouTube. And then also the one from the emerging markets, which is VFEM. As you can see, the way I have my portfolio structured is the majority of my funds are in the S&P 500 VUSA, and a smaller percentage is in emerging markets, just to give me a little bit of exposure. And I've structured it like that because I do hope that emerging markets over the long term may have a slightly faster rate of growth than those big mature companies which we already see over in the S&P 500. But because anything can happen in the short term, as you can already see on screen, actually in the red are those emerging markets, and the S&P 500 really has been the winner for us at the moment. So long may that one continue. But again, hasn't actually been going for that long, this portfolio. So just a reminder that anything can happen, and we were up by quite a lot at one point. If I just jump back to the performance page very, very quickly and go and break it up by month, just a reminder here for newer investors, or just any investors generally, that really anything can happen in that short term. And you can have very, very wild swings from the upside and the downside. And that kind of average that you hear about returns in the S&P 500, say 8% a year, really is just an average, unfortunately. And you very rarely see 8% a year as your true return. You're going to have some boom years and you're going to have some bust years. You're also going to have some boom months and you're going to have some bust months too. So how you react to that really is all you can control. Like, for example, if I go back here in 2021 to the end of what we now know was one of the biggest bull markets of all time. Now, if we look here, December 2021, we'll see that cumulatively over those past few months, which I'd started the investment, everything was going up and just keep going up. We thought we could be invincible. But then some bad months come along, lots of different red months, which took the account actually into the red. Some other big dips as well. September was a very terrible one for the stock market here as well. Here we are now kind of climbing ourselves back up, back to kind of some sort of average, back to some sort of normality. You're not going to expect 20, 30, 40% per year every single year like we've had over the last couple of years. Now, one final thing just before I head over to my SIPP, if you are a Vanguard customer and you are invested in ETFs like VUSA and VFEM, these pay out a dividend every quarter. So every 3 months, they'll pay cash into your account. Unfortunately, you'll get no email from Vanguard. If anyone from Vanguard's watching, please just set an email for people and let people know. I bet there's so many accounts out there that are getting cash put into their account and they don't really know it's there. Now, for me, when I get that dividend and I build that up enough, I will reinvest that. It just have to be reinvested manually. So when I get enough for a share of VUSA, I do put that in my account and I will buy another share of VUSA. But if you have a smaller account, you may build up cash. It may take a while actually to build that cash up to be able to buy a share. So that's one thing to pay attention to. In that example, you may be better off buying a mutual fund which automatically reinvests. So look out for those accumulating ones. There are some on Vanguard, but they don't have any accumulating ETFs, at least that I'm aware of. So just pay attention to that one. Okay, jumping over to my pension account, my self-invested personal pension, you can see here we're at a value of 42,138.17p. Again, this is more for newer viewers rather than the regular ones who'll know that my personal pension is one that I've got all of my previous employees' pensions and I've requested to transfer them from various suppliers. I think the likes of Legal & General, Aviva and Scottish Widows. Got them all moved over to my Vanguard so I could personally manage them. Now, I don't think this is something that everyone should do, and please seek professional financial advice if you are looking to do this and you're not sure, because I'm not a professional financial advisor, but it was just something that I wanted to do personally for me. Keep my costs low and move everything across, but really take it seriously and make sure you do your own research before you make a big decision like that, because your pension really is for the long term. You can't take it out until you're 58 at the moment as rules stand. That might change later on as laws change and the government changes those things. But anyway, you get the point. And again, the makeup's very similar, other than the fact that this one is in the red. This one's in the red because I moved it all across as a lump sum, and unfortunately the market's been tanking. But for the very long term, it doesn't faze me at all. I'm not concerned. I will in the future look to make more contributions to my pension, to the SIPP, once I've maxed out my ISA, but at the moment I'm nowhere near being able to do that currently. In terms of holding, this looks very much like my ISA. In fact, the majority, even more, is in VUSA, and then just a very small amount in that emerging market stock index fund. This time it isn't an ETF, it's an index fund. This is one I actually moved across from my Hargreaves Lansdowne account to actually create this SIPP in the first place. So that one I'll just leave there, and thankfully that is an accumulating mutual fund, so I can pretty much set and forget that one and let it go. In terms of performance, you can actually see when I moved this one across, it was back in April 2022. And pretty much from that date, things have been going all the way down. As soon as I moved things into the account, the rest of 2022, the rest of the roller coaster stock market that we've been in pretty much hit home. As you can see here, personal investment returns absolutely tanked, over £1,000, another £2,000 there. But July had a bit of a rebound, and we've had a couple other green months to get our cumulative returns up to where they are today, still in negative territory. But for the very, very long term, and this is a key thing, and if I don't stress it enough on this channel, long-term investing is the only way forward to make sure that you're not really worried about what you see in the fluctuations month to month. Truly, all I care about is the next 20, 30 years to be able to help grow and compound my wealth. Anyway, that wraps things up for the portfolio update for the end of 2022. If you do want to follow any of my other portfolio updates, I will leave the playlist up here on screen that goes through all of my accounts with complete transparency. We have Hargreaves Lansdowne, Vanguard, free trade, a little bit of Lightyear, and I think that covers everything. Anyways, if you've enjoyed the video, drop me a like on the way out, subscribe for many more, and as always, happy investing.